Hello and welcome to NDTV Profit. You're watching The Portfolio Manager. My guest today is Vineet Arora, who is the Managing Director and Head of Investments Asset Management at NAV Capital, based out of Dubai. NAV Capital is a fund house which is in the Dubai International Finance Center. It has two funds which are registered with Singapore Monetary Authority of Singapore, and it invests in some of the small cap, micro cap, and mid cap companies in India. Vineet, thank you very much for joining us on NDTV Profit. My first question to you is that, a large chunk of your portfolio, you have been focusing on investing in some of the small and micro caps, especially if I see you're one of the largest anchor investors for some of the SME platforms, companies listing on that. My first question to you is that, how do you go about selecting stocks in these small and micro caps?
Thank you, Sajeet. Thank you for having me on the show, and good morning, everyone. We've been focusing on SME sector, largely riding on the India growth story. Of course, the selection involves a lot of travel. As I said, I spend about 2 weeks a month in India, and so do two of my analysts who extensively travel across the country, length and breadth. We largely focus on tier 2 cities because that's where you find most of these SME companies doing well. A good hub for us has been Pune, Maharashtra, Ahmedabad, or cities around that. Some in north, some down south, a couple of them in Calcutta. So key is literally actually meeting these companies, understanding the business model, understanding the promoters, because balance sheets get made at 1,000, 2,000, 3,000 crores. At this point, you're looking at companies who've never had access to capital. You're infusing them with capital to take them to next level of growth. So apart from businesses and the promoters, it's literally the family or the people who are running the business that's very, very important that we look at. And a lot of companies we met long before the IPO process. So sometimes we invest pre-IPO and kind of we see the journey, how they're performing. It's a continuous engagement because data points are very, very sparse and scarce. Rely much on data, but you rely a lot on what you see on the ground yourself. That involves large part of the selection process. Of course, we have our own matrices and parameters that we look at before we invest into a company. If it ticks all the boxes, we go in, but then it needs a lot of patience because one has to be aware that the company never had access to capital. They've just got capital, so you need to give them time to do their capacity expansion, put up a new plant, or build up their bench strength, depending on the business they are in, and work with them, help them wherever required. So it's a lot of mentoring and nurturing involved in the process.
I just wanted to check with you on the process there, because you yourself mentioned that many of the companies don't have a balance sheet. They are first time coming into the public markets, and there's a window for them so that they can list on the SME platform, and once they mature, they can migrate to the main board. How do you finally decide where to invest, because the investing norms are also a little different for the SMA platform. You have market makers who will make for you, or make market for you, and entry and exits are a little higher. I mean, unlike the main board, you have a threshold level of investing even for retail, and you come from an institutional background. How do you go about in saying that what kind of liquidity I need before I invest in an SME platform?
So liquidity is again a process. It happens over time as the market looks the value in the stock. Of course, when a stock list, there's a lot of liquidity, but for somebody who's looking at just the initial pop, that works well. But liquidity will dry out after a couple of weeks and then rebuild if the company continues to do well. So some of the things that we look at when I look at a company, the company has to be profitable consistently. It should be growing faster than the industry, much faster than the industry, despite limited capital. It should also have a very small market share, and that goes in line with the growth and a smaller market share. So that becomes a very, very key metric for us. Promoters have to be good in terms of their background checks, and it should have some moat about the business. There are companies that we invested, for example, Enron Technology Services, we invested in the IPO in December, Jan last year, a year back. Uh, the company was facing a challenge wherein the government said make in India for certain types of machinery in the airport services sector. Uh, and there was nobody manufacturing it, and these were the guys who were servicing it, literally with a 90% market share, very small business, but literally turned out to be a sweet spot. All that company needed was capital to set up assembly lines and take it to the next level. Uh, so we like that business. Or if I have to take example of paints industry, let's say Asian Paints has a 59-60% market share, having a CAGR of, I don't know, 12-13%. How far it can grow from here after reach 60% market share? If I have to look at that industry, I would look at a company with a niche market, maybe a point market share, 0.1% market share, and it growing to 1% market share with the infusion of capital. So it's a very different approach. Somebody like us would never buy an Asian Paints, but would look at a smaller player who's starved of capital and can ride that growth curve if they get the capital.
Vineet, what could be the holding period for such investments? Because if a lot of retail investors also look at SMEs, and we have seen nearly 148 SME companies getting listed on both NSE and BSE platforms, and many of them during the IPOs have a huge oversubscription that comes in. That also translates into a higher price on listing as well. So, what should be the holding period for investors, given the fact that we see a lot of investors in India today who are flippers in the first week of listing?
So bulk of the investors are actually flippers. If you check the data, most of them sell on day one and day two. And especially with the frenzy going on right now, IPOs getting right, 400, 500, 600 times, some even 1,000 times. It's a question of, getting a lottery ticket and winning that lottery, and you sell on, listing gains of 100%, whatever, 200%, capture the pop and get out. But that's not really the right approach. We never define a holding period, but ideally, if I'm getting into those companies, we would look at least 2 to 3 years for them to actually grow to a level that was envisioned. If a company wants to set up a new plant, the plant will not be set up overnight. It'll take probably a year. After that, it needs to, operationalize the plant, kind of drive the growth, drive the sales, make it, in terms of get all the parameters right, in terms of profitability, in terms of margins, etc., some rationalization. So you need to give time. As long as we feel that the company and the management is in the right direction, we will not sell. Rather, in a lot of instances, we've been actually buying at even 2x or 3x the price because we can see where the company is going, where the management is going, and the growth prospects for the company.
And similarly, what will be the exit strategy or exit methodology? Because, as you said, liquidity will be very little. Many of them would have exited during the first week. And if you're holding on for a period of time and you have a substantial stake in the company or substantial shares in the company, exit is not going to be as easy as in the main board. So how does an investor who wants to hold on for a couple of years, exit, have an exit plan for the SME platform?
So a lot of companies, if you see, if there are about 1,000, 1,100 companies which are listed on SME, about 200 have already migrated to the main board. With the new regulations coming in, where now they need to be there for 3 years and meet certain capital criteria. So if you've invested in a bona fide good company, gradually it will move to the main board and liquidity will dramatically change. Having said that, we have not faced an issue in terms of exit. Of course, if you want to exit, you just don't go and place a large sell order, which is not good for the market, for the ecosystem. You do it slowly. In our case, because we have continuous inflow of capital, we are never under pressure to sell. So if you have to exit, we'll calibrate it over kind of a month or whatever time it needs.
Because I'm looking at your, your returns since inception is around 146%. that's a huge return, and given the fact that you have a good exposure to the SME, you're the best person to say how to play the SME platform and trade or invest in SME companies and get returns from there. Do you find that all companies which are coming on the SME platform are able to scale up to the promises that they have made?
Not all, but quite a few of them are able to scale up. So if you see, we probably invest in one of the 10 IPOs that comes in. And a lot of these companies, we've actually been watching and talking to them way before the IPO. It's just that, and that's again a journey. It's a very casual approach where we speak to about 4 to 5 portfolio companies every day on a casual basis, just trying to see what they're doing, where they're heading. No specific questions, but a normal casual chat, and answers come in, and that gives you a lot of comfort or discomfort as you go along. The key is if you look at India and as a growth story, now of course we don't have to sell India, but it's driven largely by SME. India's almost 30-35% GDP comes from the SME segment. SME segment generates about 40% of India's employment. There are about 600,000 odd SMEs in India, of which probably 50,000 are listable, and only about 1,000 have listed. So we've just scratched the tip of the surface. There's huge value out there. Unfortunately, these companies have never had capital, never had proper balance sheets, corporate governance. They never knew that they have to do this. But what has happened is, I think, since 2016, for me, what I look at is the changing point. When demonetization happened, a lot of these companies were forced to come into the mainstream cash business stock. This was followed by digitization of Indian economy, GST reforms. So now a lot of these companies have proper balance sheets, but not capital. Think of a company having a 30-40 crore top line, generating a PAT of 1-2%. Promoter has a family to take care of, doesn't get bank lines. So whatever he earns, saves, goes back into the business. And with that, he's able to grow 15-20%. Now, if he gets 15, 20, 30 crores of capital, and you can see that he can scale it up to from 40 to 200, 300. And gradually the time will tell whether he can go to 2,000 crores or 20,000 crores or not. But all the big companies today were SMEs at one point, by definition. Whether you look at Amazon or Apple, or in India, you look at any of the large groups, they all started small.
So my final question before we go into a break. We've seen some excesses also happening in this segment, in the sense it's overheated. Regulator is constantly watching on it. There's always this thing of, whether this segment is there is some abuses being done by either the bankers or the investors, or for that matter, companies who are coming into that platform. How do you caution a retail investor who wants to invest in an SME company and stay away from all the red flags?
I think so. There are many merchant bankers in the industry. So my first check for retail investors would be look at the active merchant bankers in the segment and look at their performance, because they are the ones who spend months doing their due diligence. Whether it's creating a corporate governance structure, whether it's preparing a DRHP valuation, etc., etc. So for a retail investor, that's a public data available. There's a public data available on the anchor investors, and you can see their track record in terms of the companies that they've invested, how they've fared a year or 2 years or 3 years down the line, and whether they're still holding the company or not. So I think that kind of analysis, apart from reading on about the company, spend some time on the DRHP, try and get hold of the investor presentation, spend some time on that, rather than just looking at a grey market premium and applying for the IPO and waiting for a lottery. So one has to be cautious, and retail investors can do little due diligence, but there are enough tools available which are more of surrogates rather than direct data points available.
We need to stay on. We'll be back after a short break where we will discuss some of the portfolio of Vineet, where he's invested, especially some of the interesting sectors and SME companies that he has invested in. Stay tuned to the Portfolio Manager. Welcome back. You're watching the Portfolio Manager, and I have Vineet Arora, who is the MD and Head of Asset Management at NAV Capital. Vineet, let's take us through your portfolio. You have roughly you spend 20% of your investments in pre-IPO, and then followed by micro and small cap, which is 60%, and then you have 20% cash. What is the reason that you keep 20% cash? Is it because you need to have the dry powder for this quick investment, or the secondary market opportunities that you look for?
So over the last 2 months, our cash holdings have gone up, largely because we've seen some froth in the market, and we are being extra cautious by holding some cash, waiting for some corrections. The second reason we hold substantial cash is sometimes when a good opportunity comes in a pre-IPO space, and you need to move fast for that, you need to have cash ready. It's your ability to actually give capital to a company when it really, really needs it. And as investors, it helps you to get a better price point of entry pre-listing. Third reason we hold cash is because it's a liquid fund. So if somebody wants a redemption, we don't want to be under pressure to sell anything. That's largely three reasons that we hold substantial amount of cash at all point of times.
So if I look at your sector allocation, you have RAS, which is a sector. Can you explain what is that for us? And you have nearly 20% allocation to that sector.
So 20% has grown because of the companies that we invested have grown multifold from the time we invested. But it's quite an interesting space. So I met a promoter about 2 years back, slightly more than 2 years, who's running a managed offices business, looking to list his company, trying to raise capital. Around the same time, WeWork India raised about $300 million at $1.2 billion valuation, operating 64,000 seats. We looked at this company, $10 million valuation, 18,000 seats, and profitable even during COVID. Understood the business and why others are not able to crack the code, and this guy is. And we went and invested in the company. And we participated in subsequent rounds as well. Stock has done almost 23x from our first round of investment now.
Which is this company?
This is called EMS India Limited.
Okay.
So now the market cap is fully diluted basis about 2,500 crores. Uh, but first investment was at 85 crore rupee valuation. So if you compare 1.2 billion to $10 million, 64,000 seats to 18,000 seats, loss making to profit making, I think it was a no-brainer at that point of time. Uh, we also invested in a company called TCC Concept. Again, it's been 2 years of journey now. Now we've kind of started to see the fruits where the company is ready to launch its products in the market. Path breaking on the real estate side again. More on the real estate services side as commercial broking and allied services. But again, they've done some phenomenal work in last 2 years, and we've seen the journey.
So within the SME space, which are the sectors and teams that are working for you? Because as you go to mid and higher, the sectors are very broad in nature, but the teams are not there. But you get those teams in the smaller companies and micro cap companies.
So some of the companies that have worked well for us are in the IT space or IT services, but not like a servicing model, what a Wipro or a Infosys would do, but very, very niche players who are, either imparted trainings or making modules for some of the larger players, doing some back-end work, but which is high-tech. Some of the investments have done well on the, for example, digital studio side, which I would put in the same basket as technology. Drone sector has done very well for us. We were the anchors to the first drone IPO, which was Dronacharya in India. The third one, which is Drone Destination. We did not invest in IdeaForge because we found it a bit too expensive. So these have done well for us. In general, ancillary services across sectors have done well. We've done spices, we've done semiconductors. As we talk, we are investing into the company which was our first investment from the fund, which is a fintech SaaS platform, which has scaled up very nicely, highly profitable, and kind of now we're looking for ways to take it public. So we are doubling down or tripling down now when kind of it's right.
And you're also invested in consumer appliances, right? Or consumer segment through Inflame and other companies as well.
Yes.
So how do you see that market growing?
So consumer sector in general is doing okay, but of course, it's driven by spending, and especially the rural side has done quite well. So a case in point would be FMCG company on the spending side, Annapurna Swadhisht, wherein we did pre-IPO at 40 rupees. IPO came at 70, and I think it traded at 330 or something. We continue to hold. We haven't sold. Inflame has done quite well. They're into appliances manufacturing, but they're more of an outsourced player where they supply to larger players like Havells, etc. So this is like, you investing into a Dixon, which is onto the appliances and TVs and other things. This is the lower end of similar segment.
And what about pharma and healthcare? I mean, I see Sotac Pharma is one of the companies where you have, some investment.
We invested, we continue to hold. Fantastic team of people running the company, very, very down to earth. They've set up a new plant which is just becoming operational. So we'll start seeing the traction now. Again, we invested almost a year back. I think the IPO came in April last year. So you need to give time for the plant to come up, the capacity utilization to come up, the efficiencies to start showing. But we stay invested. We invested in Trident Pharma. That's done decently well. Again, we stay invested. That's more on the intellectual property rights side of business, API side of business. This is more on the manufacturing side. So same industry, but different segments.
Finally, you have sizable stakes also in this. It's not just that some shares, but you have sizable stakes. Do you guide them through the process of moving from a SME platform to a main board as well as investors, long-term investors in these companies?
Yes, we do. As I said, we talk to 3 to 4 companies on a daily basis. probably meet all of them in a 6-month period. We try and understand the challenges they are facing. Wherever we can add value, we add value in the system. Whether they want to talk to a supplier in some other country or a buyer in some other country, to actually help them articulate what they're trying to say, because a lot of them have never done it. Or help them, go in the right direction. And because, let's say, we are invested in 40, 50 companies, we try and see a mutual fit also within our investment portfolio, wherever we can add value in terms of cross-introducing them to companies in a portfolio, so that both of them grow.
Vineet, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit. That was Vineet Arora, who is the Managing Director and Head of Asset Management at NAV Capital, taking us through some of the nitty-gritties of the SME platform, where he is a large investor in many of the companies through anchor investing and subsequently. And thank you for watching today, The Portfolio Manager.
Nifty Sensex off the day's high, RIL, IndusInd Bank and HDFC Bank drag.
Well, the IPO market is also a market for traders and not just investors, says SEBI Chief Madhavi Puri, adds that 43% of retail IPO investors flipped within the first week.
IndusInd Bank is the sole loser on the Nifty Bank Index. The bank's net margin interest remains stable in Q3, while interest income gains 18% on an annual basis.
Well, it's an earnings heavy week on the Nifty. You have Reliance Industries, HUL, Ultratech, all are expected to come out with their December quarter earnings today.
Today on NDTV Profit, we get to you top voices from the World Economic Forum Davos, where top economists and corporations are speaking about the changing landscape of the business world and the global economy.
Good afternoon and welcome. You're watching Market IQ on NDTV Profit. I'm Harsh Saida. With me is Pallavi. We're going to take you over the next half an hour about all that's happening in markets. Let's quickly look at where the Nifty and the benchmarks are at. You're looking at 0.7% of gains on the Nifty 50 around. The Nifty is roughly 60 odd points above its day's low, so that's one positive way to look at it. Let's also look at the contributories as we speak. You're largely seeing gains coming in from the likes of an ICICI, Bharti Airtel up nearly 4% in trade today, and L&T and Axis Bank leading the charge. Can we also have the heat map there just to kind of figure out as to which stocks are gaining and losing? And you'll see on the map the top gainers, the likes of an ICICI Bank, Bharti Airtel, even an ITC is up 1 odd percent, and an Axis Bank among those who are leading the charge. In terms of the losers, well, it's an advance heavy week, or rather an advance heavy day, I beg your pardon. 4% higher on Bharti Airtel, as you can see. NTPC, ONGC also leading the charge, roughly 2.5 odd percent higher is even Tata Steel, ICICI Bank. In terms of the declines, just about 8 led by IndusInd Bank, 3.5% lower on the back of those poor or weakish sort of numbers. The numbers were largely in line. Actually, the slippages came in slightly higher than what the market was expecting, and that's what's keeping the stock in news, down 3.5%, the top loser on the Nifty 50 today. Let's quickly look at where the broader markets are at. You're seeing the Nifty mid cap and small cap both gain 1% plus. That's a healthy advance after the week that we've seen for the Nifty 50 as well. You're seeing the Nifty Bank around 0.2% higher, but outside of that, the Nifty Fin is up around 0.9% today, which is again a positive. Outside the financial pack, the Nifty Metal is gaining 1.3 odd percent. Again, a positive there. That's the top sectoral gainer for the day. Among the losers, we have the likes of a Nifty Media, probably the only sole loser among sectoral indices. And if we can look within the Nifty Media to quickly check as to what the constituents of the Nifty Media are doing, you'll see that largely the losses are driven by Z and Dish TV. Outside of that, you are seeing green across the board. So Nifty Media, specific pocket which is seeing a bit of red, but outside of that, you're seeing good buying that's happening, and it looks like the market is going to stay in the green through the day, at least today. At least that's the cues we're tracking. Last off, I want to look at the advance decline as well, Pallavi, because it seems that we're in favor of the advances, but how much? There you go. 3:1 in favor of the advance.